Well, good morning, everyone. It's just gone 11 a.m., so we might as well kickstart the webinar today. So welcome, everyone, to the BetaShares Franklin Templeton Active ETFs Income Opportunities in a Low Yield Environment. So just getting a bit of admin out of the way before we jump into the webinar today, just letting everyone know that this will be recorded and you will receive the recorded webinar at the end. And of course, if there's anyone in the office that you know that couldn't attend, they'll also get it if they registered. And as always, please write some questions as we go through there, as we will dedicate some time at the end to cover that, either myself or Will. Just giving you a moment to look at the slide here. Obviously some important information. Probably one key thing to pull out is obviously any information given today is very much general advice and doesn't constitute any personal advice. So just highlighting that one and give you another moment just to have a quick read. Perfect. So very fortunate to have Will Baylis with us today, who's a portfolio manager at the Martin Currie team there. So thank you very much, Will, for making the time for us this morning.
A pleasure, Chris.
No worries, mate. And myself, Chris Yates, I work as a director here at the BetaShares business on the advisor service and business side. So again, thank you for everyone for attending. Looking at the agenda, well, we've got the welcomes out the way. I'll be giving an update on BetaShares and our partnership with Franklin Templeton. We'll be covering around Martin Currie and, of course, looking at our equity income strategy in EINC there, which is high income that grows with you, and also the real income strategy, which goes under that ticker code of RINC, which is real income from real assets. Also, what I'll be looking at is how do you use these in your portfolios, and of course, dedicating some time at the end to answer any questions. So a quick update from BetaShares and Franklin Templeton side. BetaShares, of course, we are a leading ETF provider here in Australia, which actually we're at 13 billion under management as of Friday last week. So our strategies and ETFs are very strongly adopted, and thanks to all the support from any of the advisors that are logged in today for selecting us in their portfolios. In terms of our active ETF strategies, we do provide a number of these and have partnered with Franklin Templeton and Legg over the years. Today we'll be focusing on the BetaShares Legg Equity Income Fund and also that BetaShares Legg Real Income Fund under RINC. But also we provide a very high quality, high conviction emerging market strategy, which is the BetaShares Legg Emerging Markets Fund, which is also managed by the Martin Currie team out of Scotland, which goes under that code of ENMG, and also for that fixed income allocation through the BetaShares Legg Australian Bond Fund under BNDS. So these active strategies are just giving access through the assets to some very high conviction, high quality specialist managers in Martin Currie and Western Asset. Now, just to highlight, I guess you do see Legg in the name of those funds, but we do see Franklin Templeton up on the top right corner. Of course, Franklin Templeton acquired Legg back on the 31st of July this year. And what that meant is now that Franklin Templeton is the 6th largest independent asset manager in the world. It's managing over $1.4 trillion of assets under management as of the 30th of June, and really just providing a very broad range of investment strategies. And of course, giving access to over 1,300 investment professionals, 12,000 employees, and with over 70 years of asset management experience. So very happy to be partnered with the Franklin Templeton team. So that's sort of the update from my side. I'll chat with you guys at the end. I'll pass it over to Will now to cover Martin Currie, the equity and real income strategies. So I'm just going to pass the controls over to you now, Will.
Thanks, Chris.
Okay, you should be able to have a go.
Righto, let's see. Okay, so good morning, everyone, and thank you for the introduction, Chris. So Martin Currie as Chris mentioned, we report up to our head office in Scotland. We account for about $20 billion of funds under management. And as Chris mentioned, we're owned by the Franklin Templeton Group. We've got 21 professionals in our team, of which 10 analysts who've got about 24 years experience, and a number of portfolio managers and execution staff and support staff, etc. But the capability of the team is really the experience. And I think the average tenure in our team is about 12 years with Martin Currie. So Chris, I might get you to move the slides. So moving to slide 10. So we'll start with the equity income strategy, which, as Chris mentioned, is under the BetaShares ETF, is the EINC strategy. So we designed this strategy back in 2010. It's benchmark unaware, and it's highly diversified across economic sectors to hedge against inflation when we used to have inflation, but also importantly to hedge against the cost of living, which we certainly do have. And it does maximise the full value of franking credits. So we tend to assume that the investor in this fund is either transitioning from an accumulation to a retirement income product or is already in retirement. It does capture that fundamental and qualitative experience from the team, as I mentioned. And it also is very much a forward-looking strategy. So you'll find I'm talking about the next 12-month yield and the next 12-month income because we do forward-looking investment analysis and return analysis. So moving to the next slide. And these are the characteristics. You know, we can't own more than 22% of any one sector. And so, for example, in the banks, you know, we're approximately 16% in the banks, whereas the banks are around 21% of the index. Turnover is typically low, but I will come to some of the changes we've made this year in defending income. And I think I've talked about the tax awareness of the strategy. So moving to the next slide. This slide goes back to May 2005, right up to the present day, and it shows the income received from $100 invested 15 years ago, which for the market, this is for the index, which is the blue line, compared to if your clients had all their money in a term deposit. And you can see on the right-hand side of the page that the volatility, the income volatility for term deposit has been 3 times that of dividends for the market. And that even takes into account the recent cuts in dividend that we've seen in the 2020 year. So you can see if you're seeking income in retirement to fund your cost of living, a term deposit strategy, which was brilliant back pre the GFC, has turned out to be a really poor or dire strategy for income today. On the next slide, this highlights how we think about maximising income for the portfolio, and it's all around what we call portfolio quality distribution. So high quality companies tend to dominate the strategy, and we tend not to invest in low quality companies. Examples of quality are the barrier to entry that the company has. So how much market share does it have? Does it actually have meaningful internal cash flow generation characteristics? Does it have a long-term return on investment capital, which is reasonable? And is the industry that it's in what we call a high-quality industry? And does the company have high-quality management and board and so on? And we find that rather than looking at payout ratios, we think quality is a much better determinant of the ability of a company to pay dividends going forward. The next slide just talks about the diversity. So it's a waterfall slide, and what's always surprises me when I talk about this is if you were investing in just the index, you'd have 7 companies which account for nearly 65% of the total income for the market. And you can see that you know, the banks dominate that, right? And whereas the right-hand side shows the waterfall nature of our portfolio, where there's, in the EINC strategy, there's 35 names, which give you much more diversity in relation to the sources of income. And one thing I should remind you of, not only do we cap our sector limits at 22%, but we cap our stock limits at 6%. So we're always going to be owning, 35 names. We're never going to be owning 10 names or 15 names, or like the index 7 names. And that really ensures proper diversity and proper risk management when your intention is to generate income that grows above the cost of living and a yield that's well and truly above the index. So the next slide is our top 10. And, the good news is that every company on this page have paid dividends. Even ANZ Bank, which you may recall back in May, they deferred their dividend. They've now given us an August update, and they've now paid that dividend. And you've got companies like Horizon, where they've actually maintained their dividend. You've got companies like JB Hi-Fi, which have actually had a 40% lift in profit and I think a 35% lift in dividend. AGL, which has had issues with the fall in the wholesale electricity price, has still very high free cash flow and has declared it will be paying a number of special dividends next year. And then Telstra, which some in the market think had a slightly disappointing result, has still paid that 16-cent dividend. So the reason I'm highlighting this is a lot of our analysis at the moment and a lot of our activity in the portfolio is about minimising the drawdown in income. So our view is, if your clients are holding this strategy for income, which is obviously the whole objective of the strategy, they actually would hope that we minimise the drawdown in income. And we think that our portfolio will show about a 20% fall in dollar income this year, which I'm sure in your client's eyes is not, they're disappointed. But if they were in the index, we think the index could show about a 35% fall in dollar income. So all of our efforts in terms of how we've structured the portfolio, the stocks that we own, the focus on quality has been about shoring up that income and trying to minimise the fall in a very difficult year. The next slide. This just speaks to what I was talking about in terms of how we designed the portfolio. So left-hand side shows that we've got quite broad sector diversification. And you'll see that metals and mining is relatively low, although we have more recently put BHP back into the strategy. Reason for that is commodity prices are very volatile, and I'm sure a number of you will remember when the iron ore price was $180 a tonne, and then it collapsed to 30. And so you've got to be careful owning too many mining companies in a strategy like this. But equally, you don't want to be having a big weighting to banks, and we've seen that what's happened to banks' dividends in the last year. And so we've tried to diversify our risk with non-bank financials and consumer discretionary. And the right-hand side just shows you that, we're far more underweight the ASX 20 than the index. And we've got quite a large exposure, relatively large exposure, to the small ords. And we're well placed in the 100 less to 50. And note that we have very little cash. So we always leave the asset allocation to the financial advisors that BetaShares service. Our view is, if you're in this strategy, you want the dollar income, so we're always going to be fully invested. And the next slide just talks about COVID. Back in March, we went through with a fine tooth comb, I think is the expression. We looked at any risk around solvency for each company in the universe. We looked at any risk around bank covenants. We clearly wanted to work out the dividend paying potential for each company this year. So we actually do think about what's called sustainable dividends, and we think about those being paid out of 8 out of the next 10 years. We're clearly in that 9th and 10th year where even those sustainable dividends for many companies weren't achieved. And so we actually determined a COVID type dividend for each company back in March, so that we could try, as I said earlier, to minimise that drawdown in the total income. And you can see that the turnover for the quarter is 17%. And those of you that were looking at some earlier slides, typically our turnover for the year is around 20%. So the turnover for the quarter has been unusual, but that was because we wanted to move out of things like Sydney Airport, who didn't pay dividend. We moved out of Boral, who didn't pay dividend. And we think Sydney, by the way, is going to be heavily impeded, given that the international borders are likely to be closed for a lot longer than our domestic. And we moved into stocks, or added to stocks like Horizon, Ingham's Chickens, just to name a couple of unusual stocks, and others like Coles and JB Hi-Fi. We've kept a reasonable position because we had a much higher surety or probability that those dividends would be paid, and fortunately they have been. The next slide just shows that, as I said earlier, we think we're always trying to think about what's the next 12 monthly or next 12 month income. Sorry, I'm just re-logging back into my computer. But this slide talks about, yep, so I'm back on deck. This slide just shows that on the next 12-month basis, or next 12 months, we're looking at 145% premium to the market in terms of the income, the yield on the portfolio. And that's part of our objective, is to deliver a yield that's normally 20% higher than the index, and at the moment we're tracking about a 45% premium to the index. And clearly growth is important, and as I said earlier, we'd probably like to see about a 20% fall in income this year, but the long-term income achievement of this portfolio has been about 2 to 3% per annum since 2010, and clearly maximising the value of franking credits has really helped that. So moving to the next slide. Whoops. So, yep. Just finishing off on performance. On a net basis, the fund's seen about a 14.7% decline in total performance, but the yield in the fund on an expected basis is going to be around 6%, and we would certainly expect dividends to be a lot more stable going into the next year than they have been in the last. In fact, coming off a low base, you could expect to see dividends growing at around maybe 3 to 5% in that order. So that's all on the equity income strategy. Now I'll move to the real income strategy. So if we maybe the next slide. So the RINC strategy, as it's known under the ETF, invest in much more defensive type assets, so utilities, infrastructure, and AREITs. And it typically likes to own what we call brownfield assets. Demand is typically driven by population growth, and certainly that's going to be a headwind for this strategy over the next year or two, given that immigration has slowed from 1.8% to about 0.7%, back to the natural birth rate. But importantly, because these companies are delivering essential services, they tend to be quite resilient. And what's been really unusual with COVID is these companies are actually the first hit because of the artificial nature of shutting down the economy. And so, I can talk about some of the risk around that, but in essence, the COVID issue around real income has simply highlighted that if you artificially close an economy, some of your most defensive assets will be impeded. Now, this slide shows the key sectors. So AREITs, which include discretionary and non-discretionary shopping centres, and they've been heavily impacted by the restrictions placed, particularly in Victoria at the moment. Toll roads have been impacted. Transurban has seen in March, April, about a 40% fall in their traffic numbers, although fortunately in Brisbane and in Sydney, those numbers are returning quite markedly. Sydney Airport I've talked about. Horizon, because it transports coal, has been very largely unaffected. And then the right-hand side shows utilities, which have been pretty resilient, Spark and AusNet. whereas AGL's been more impacted by the fall in the wholesale price. And then, of course, you have the New Zealand utilities, which actually have held up quite well, although one of the most peculiar things there has been the forthcoming shutdown of the Rio smelter, which certainly has impacted some of the forward forecasts. But those New Zealand utilities are really, they're what we call gold class assets. They have very little CapEx required, and they still actually have very nice returns. The next slide if we just go to the next slide. This just shows how we avoid the concentration of the AREIT index. So for example, if you just had the AREIT index, you'd have Goodman Group accounting for nearly 25% of the index and Centre Group accounting for 12%. What we've tried to do in the Real Income Fund is have a much more broader portfolio of real assets, including infrastructure, utilities, and then the mix of different AREITs. And you'll be interested to know that what we've done in the AREIT space is we've really focused on cash collections. So a lot of the suburban office REITs have been, their cash collections are still really high. Dexus is 94%. And then the supermarket anchored REITs, cash collections have been around 79% to 80%. And so we've been very much focused on, the AREITs that are still doing well in this environment, and then very much focused on how can we diversify the strategy using infrastructure and utility type assets to shore up that dividend. Moving to the next slide, which is the top 10, I think. You can see the mixture of regulated, unregulated gas and electricity grids, diversified REITs, utilities, etc. Stockland, who just reported today, have delivered actually quite a reasonable dividend, and they're seeing, for example, residential inquiry rates actually up quite markedly off a low base. You've got SCA Property Group, which have mainly Woolworths supermarkets as their key tenants, still delivering reasonable dividends. I've talked about AGL already. APA, which has nearly 80% of the unregulated gas and electricity grids, has very reasonable cash flows, and then Horizon also with its monopoly over carriage of coal is actually delivered very good free cash flows and dividends. And what we won't own is we won't own companies like Peat & Co or Chorus. So Peat & Co has really high construction and development risk, and Chorus has a lot of CapEx to do on the telecommunications, if you like, the hardware in New Zealand. So we tend to avoid companies where there's large development risk, and we like to own companies which have got very good dividend paying history and quite high free cash flows. So the next slide, I won't spend too long on this, but just looking at the left-hand side of the graph, you can see all those blue dots. That was where the Real Income has sat since inception in terms of very low risk and very high returns. But see how COVID has pushed the risk up quite markedly, because a lot of those assets, particularly the AREITs, have been closed by government. We would expect, as the economy reopens, that the risk profile goes back to where it has been over the last 10 years. And look at AREITs. If you've been in AREITs, your risk or standard deviation has moved out far more than the Real Income portfolio. And so again, that's the beauty of Real. It's diversified into utilities and infrastructure. But it's an interesting chart, this one, because obviously up until February, we were illustrating how defensive Real is and how low its risk has been. But with COVID, it's been quite a marked and unusual characteristic to elevate that risk, although we think it's very temporary. And then the right-hand graph just shows the expected income. So you can see that on a forward-looking basis, the expected income, which is the orange line, still looks quite reasonable, compared to where it's grown back in inception, when you would have got just under $8. And then the diamonds is what the fund's paid relative to what we've been expecting. And generally, we've been paying distributions either above or what we've been expecting. And then the next page, which I've probably already talked about, is the impact of COVID. Let's get Chris to move that. Performance, sorry. So, you know, you may recall the EINC fund has fallen actually less than real. And so real's fallen about 21% this year. Not that I'd be too alarmed by that, because I think I've explained the unusual aspects about COVID and artificially shutting the economy. What's interesting is the dividend on this fund is probably going to fall about 12 to 14%, you know, compared to the market down about 35, as I mentioned earlier. So the dividends and coming from the free cash flow of these companies still held up relatively well, whereas the EINC strategy, as I mentioned, you're going to see dividends down about 20, or the income on that strategy down about 20. Good news is about both these strategies is as the economy reopens, we think both strategies are very leveraged to the reopening. Next page, please. And that's, I'm going to hand over to Chris on this. Just a final comment though, before I do. If you step outside Victoria and look at what's going on in New South Wales, and if you look at what's happening in Queensland, we were speaking to Suncorp yesterday, and they obviously do a lot of insurance of motor cars and houses. They reckon traffic volumes in Brisbane and Sydney are now back to pre-COVID. In WA, you talk to retailers, they reckon that WA is now behaving as though it doesn't have the virus, and it doesn't, but behaving in a very pre-COVID manner. So the fact that Queensland, WA, New South Wales, to a large degree, in certain sectors are getting back to pre-COVID levels does give us great hope that as Victoria comes out of this, we are going to see, you know, much more positive growth rate in income and reasonable yield next year. But I'll hand over to Chris now. Thank you.
Excellent. Thank you very much, Will. And I can already see that we've got a couple of questions come through while you were presenting then. So we'll definitely get you back to answer those in a short while. So just looking at the Equity Income Fund as a snapshot, and again, that trades under that ASX ticker code of EINC, which of course you can access through any ASX trading platform or RAC platform. And around that investment objective of the fund, again, it's an actively managed strategy orientated around Australian shares to provide an after-tax income above that of the ASX and grow that at the rate of inflation. And then we have the Real Income Fund, which again, as Will covered, it's giving you a diversified exposure across Australian real assets, the AREITs, utilities, and infrastructure securities. And again, looking to get that after-tax income above the ASX and grow that above the rate of inflation, going under that ticker code of RINC. So I guess to this slide here, why we see investors and advisors use the equity income strategy and the real income strategy, even more so now. I guess as an advisor and as an investor, where you are deriving a lot of income from your traditional safer asset allocations through fixed income, term deposits, as Will highlighted at the start of the presentation, you can no longer do that and still meet the objective of that client. So having high quality and high conviction strategies like the equity income and real income strategies in the portfolio are really benefiting those client portfolios and those outcomes they're looking to deliver. So as we sort of covered, you know, the equity income strategy really is that high yielding, but that focus on quality companies, providing low volatility. And again, it's that forward-looking focus and giving you a smoother income from those companies because of those concentration caps over the companies. So you're not relying on one or two names to deliver the income objective of the portfolio. And again, you're avoiding things like dividend traps by not relying on that and giving that more diversified income stream. So that's why we see advisors allocate to the equity side of their portfolio through the equity income strategy. And then, of course, looking at the real income strategy in terms of allocating to that property asset allocation piece in the portfolio, it's looking back again at the sustainable income that's growing above inflation, and back to that same word that we keep hearing, it's focused on high quality stocks. And again, when we traditionally see investors invest in this space, either they'll go direct, and as Will highlighted, they'll usually use one of those names, which is going to give you a high level of concentration risk around the performance of that particular name. And even on a passive AREITs 300 basis, you're still getting a lot of concentration risk to the top 4 or 5 names within that particular index. So again, this is giving that diversified exposure across those bond proxies in terms of AREITs, infrastructure and utilities, plus also giving the ability and using the expertise of the Martin Currie team and Will to be able to maneuver and position that portfolio as we see changes in the market like we have through COVID, being able to move into particular companies that may benefit from people staying at home. So that's the real reason why we see these strategies. And again, it's that high conviction, high quality active strategy that has been proven to be able to outperform their relative benchmarks over a long time period. So just, I guess, moving on from there, things to obviously consider: investment risk. No guarantees in terms of future outcomes are uncertain. Again, it was only general information provided today and didn't account for anyone's personal circumstances. So questions, there has been a few questions come through. I guess the first one, and this one will be for you, Will. I guess one of the questions is they believe that you sent a letter out, and I think that letter is actually as in the handout if people on the webinar want to actually open that up themselves, a letter to companies that you hold within the equity and real income strategies, and just, I guess, stating the power of dividends for these income reliant clients like your self-funded retirees. It'd just be good to give, I guess, your view on why you guys did this, of course, but also the general feedback from those companies that you've sent that letter to.
Yeah, sure, Chris. Thank you. So what motivated us to send the letter is that we became quite alarmed back in March when companies just said, look, we're not going to give any guidance. And then we became quite alarmed when a lot of companies just said, look, we're deferring the dividend, because no one quite knew what deferment meant. You know, did it mean that they wouldn't pay it at all, or would they pay it in August like ANZ have, or Harvey Norman, or, you know, would they not pay any dividend at all in the year of 2020? So the letter was to companies stating that if they were in a reasonably strong financial position, they had, you know, reasonable capital in the case of banks, or reasonable capital buffers, and they had strong free cash flow, even if they were to cut the dividend, it would be greatly appreciated by their retail investors and self-retired fundees, etc., if the dividend were to be paid. And the response we got was overwhelmingly positive. One of the largest companies in the EINC fund, the chair wrote back and he said, look, they've been advocating since 1990 that we need to lift our payout ratio, pay dividends, and we can always get about 10% of our capital back through the DRP, which is typically what they get. And if we are worried about, you know, funding future capex, we can actually get the DRP underwritten for a small fee. And so this is one of the largest companies in Australia that said this. And so they were very pro. And then other companies said that they really understood the importance of dividends, and they understood that self-funded retirees were dependent on dividends. And then one company yesterday said to me that they actually saw dividends not only as important for shareholders, but they saw it as a form of stimulus. Because if a company keeps a dividend back, they've got to deploy that capital at a reasonable return on invested capital. If they haven't got that return likely to be generated, it's much better to give that dividend back to the shareholders, and invariably it will stimulate the economy. So, you know, response has been really good, Chris, and you know, we're really pleased, and it follows on from a campaign we had prior to the last election where we talked about the importance of franking credits as well, and again, positive responses on both those issues.
Perfect, thanks, Will. I guess another question here is, and it's just probably more towards the real income fund, is what are you seeing in long-term city office spaces, and you know, how is that sort of affecting the positions in the real income portfolio?
Yeah, look, good question. So first thing is, in terms of how we position the portfolio, we certainly have been de-weighting our exposure to CBD property. And so, you know, I mentioned Dexus, right? So Dexus had a 94% rent collection achievement this year. And you might say, well, gee, that's surprising. But of course, what people tend to forget is a lot of these rental contracts with CBD tenants are 4 to 5 years in length. And so our view is that's still to be tested. The second comment I'd make, though, is there is definitely a view, depending on who you speak to, that offices still form a very important component of work. And, you know, companies will talk about their younger employees itching to get back to the office. That you'll get people talking about the separation of work and home, and you'll also get collaboration being raised as a big issue for why you'd want to be in an office environment. So I don't think it's clear that we're going to see a significant permanent demand loss for office space. 2, I think you're going to see a lot of redesigning of office space, and social distancing will be here to stay, in our opinion. And 3, that human need to work in teams, to collaborate and so on, hasn't gone away. And then the final point is doing every meeting on a Zoom or webinar like we are now. Humans do need to collaborate in person as well. So we think once a virus is identified and COVID becomes, you know, essentially another SARS, we do think there's a future for office, but it will be probably in slightly different format to what we've been used to.
Okay, perfect. And look, we've probably got time for one more question, if that's okay. And this one is probably again for you, Will. But look, we're going through and just been through the reporting season. Were there any standouts or shocks that you saw through that? And has that actually initiated any changes to the portfolio across both EINC and RINC?
Yeah, it's a great question. So the standouts were, you know, JB Hi-Fi, Harvey Norman, and on the back of that, we actually were buying Supercheap for the portfolio. And Supercheap, you may recall, reported yesterday and delivered really stellar results. So the big surprise was how much income from households was being spent in retail. But more importantly, we're now in August. And so we're now 6 months into COVID, and we're still seeing, like, all the outlook statements from JB's, Harvey's, Supercheap were all really positive. So to answer the question, we've actually maintained quite reasonable exposure to consumer discretionary. On the consumer staple front, we reduced our exposure to Coles because we just thought the Woolworths and Coles had run very aggressively, and so we reduced our exposure there. We thought there was better value and better yield in discretionary. We increased our exposure to the likes of Ingham Chickens, so we saw that, you know, as part of the food chain, it would do well, and, you know, Ingham's has come through okay. We exited G8 because we didn't think there'd be a sensible dividend, which there wasn't. I think I mentioned we exited Boral because we were very worried, not just about the Australian construction cycle, but more worried about what was going on with Headwater in America. And we did reduce Transurban, but we didn't exit Transurban, whereas we did exit Sydney Airport because we're terribly worried about the impact of, you know, international borders being closed. So certainly a number of changes to both portfolios that I've mentioned, but all around shoring up dividend. And I hope that I've probably answered that question across both portfolios, but obviously the strategy has been very similar to shore up income, Chris.
Thank you so much, Will, and thank you so much for taking the time to join us today on this webinar. I really do appreciate it, and I'm sure all the attendees have as well. Look, we'll let everyone get on with their day, but again, thank you everyone for attending today. As I sort of highlighted at the start of the webinar, you will get sent out a recorded version of it along with the slides. And again, if you want to look at any of the information on the equity income fund or the real income fund or any of the other funds that were noted at the front of the presentation, please go to the BetaShares website, and under the funds page, you'll find all the relevant information, fact sheets, and requests for research. So again, thank you so much for everyone that attended, and thank you, Will, again.
Thank you.